Just over a half an hour ago to go till the opening bell on Wall Street. For more on the markets week ahead, we want to bring in Sylvia Jablonski. She's the CEO and Chief Investment Officer at Defiance ETFs. And Sylvia, we are talking about the markets closing at new highs. How do you feel about those things? What do you expect stocks to do this year?
Good morning, Becky. Great to be here today. Well, I think if you look at where we are now, it actually took us, close to 2 years to just get back to where we were on the previous S&P 500 highs, that 4,800 number. So I'm very, kind of happy that we're here. And I think that the market is poised to continue to rally and do well this year. I think AI and I think rate cuts are the big story. So we got that soft landing. The economy is fairly stable and employment is pretty good. Those things often define a bull market. And then on top of that, you have this great innovation that can push the market forward with the AI theme. And, arguably rates coming down towards the latter end of the year will help companies grow and scale and improve on profits and growth. So I'm optimistic.
Yeah, optimistic to the rate of maybe 8 to 10% returns when it comes to equities.
Yeah, optimistic to about 8 to 10%. I think we'll do a little bit better than the annualized return of the S&P 500. And again, I think that's just because AI, last year was very much just an ad word. And I think this year is when it starts to become applied to different sectors, when it starts to broaden out to things like supercomputing, semiconductors, beyond NVIDIA and AMD, and the tech stocks. To me, Mag 7 are AI stocks now. They're not tech stocks anymore. The whole, shift in technology is going to be quantum computing and AI for the next couple of years. And that has, power and fuel for growth.
Often we look at the money on the sidelines, and usually we think of that in terms of cash. But this time you've got money on the sidelines, not just in cash, but in treasuries, too.
Yeah, so that's super interesting, right? So I think that's also another argument for why the market can rally. You have $6 trillion sitting in savings, slash treasuries, slash cash. And if you think about that, a lot of investors that we talk to are still like, oh, I'm fine parking there. 5% is pretty good. But when you start getting the S&P and NASDAQ, getting these high double digit 20, 30, 40% returns, and if you can get another 8 to 10% out of that this year, all of a sudden that 5% sounds less interesting. So I do think that if that money comes off of the sidelines, then a lot of investors will start shifting sentiment when rates get cut, into the market. You also get a rally, and you get a broadening of the rally too. I think there are a lot of stocks that were just beat up and haven't fully participated yet.
How much of that is reliant on earnings season? We're getting into the thick of it now, and we've only got about 30 seconds left, Sylvia.
Yeah, absolutely. You just raised the most important point. I think if earnings season isn't, as good, although the last couple of times it surprised us to the upside and we've gone into it negative, I think, that pulls us back here. That's certainly a catalyst that could pull us back. That's a risk.